Episode 4: How to research and select investments that fit your strategy. Disclaimer: this content is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. If your asset allocation is the blueprint for your financial house, the investments you choose are the bricks. And just like in construction, the quality of each brick matters. Too many investors build their portfolio walls with whatever's trending on social media or whatever their friend told them was a sure thing. But great investors? They follow a process, a repeatable, disciplined framework that ensures every investment is the right fit for their goals. 1. What fit really means? An investment doesn't exist in isolation, it exists in the context of your portfolio. A good stock or fund for one investor could be a terrible choice for another. Why? Because your allocation, time horizon, risk tolerance, and objectives are unique. Example: a 25-year-old saving for retirement might buy a small-cap growth ETF for higher potential returns. A 65-year-old in retirement might choose municipal bonds for steady tax-free income. Action tip: before you look at any investment, ask, does this move me closer to my portfolio's target allocation and my financial goals? 2. The core criteria for evaluating any investment, whether it's a stock, bond, ETF, or mutual fund, you can run it through 5 essential filters. Risk: how volatile is it? What's the potential downside? Return potential: based on historical performance, industry trends, and fundamentals. Volatility: how much can the value swing in the short term? Liquidity: how quickly can you sell it without taking a big hit? Cost: management fees, trading commissions, bid-ask spreads, taxes. 3. Stock evaluation basics, the key numbers. When you evaluate a stock, you're analyzing a business. Here are the core metrics. P/E ratio, price to earnings. How much investors are willing to pay per $1 of earnings. Compared to industry average, not just in isolation. P/B ratio, price to book, compares market value to net asset value. Useful for asset-heavy companies like banks. ROE, return on equity, how efficiently the company generates profit from shareholder money. Dividend yield, annual dividend per share divided by share price, shows income potential. Revenue and earnings growth, look for consistent growth over multiple years. Data point: S&P 500 companies with consistent dividend growth over 25+ years, the dividend aristocrats, have historically outperformed the market with lower volatility. 4. ETF and mutual fund evaluation. If individual stocks are too much work or risk, funds can be a powerful tool, but you still need to choose wisely. Expense ratio, the annual fee as a percent of assets. Lower is generally better for passive funds. Holdings analysis, what's actually inside. Check sector weights, top holdings, and whether you're duplicating positions elsewhere. Tracking error, how closely the fund follows its benchmark index. Liquidity, for ETFs, look at average daily volume and bid-ask spread. Example: 2 S&P 500 ETFs may seem identical, but one could have an expense ratio of 0.03% while another charges 0.5%. Over 30 years, that difference compounds into thousands of dollars. 5. Bond evaluation basics. Bonds are more than safe investments, they come in different types and risk levels. Credit rating, AAA is highest quality, junk bonds carry higher default risk. Duration, a measure of interest rate sensitivity. Longer duration equals more price fluctuation when rates change. Yield, the income you receive as a percentage of the bond's price. Issuer type, government, municipal, or corporate. Each has different tax and risk profiles. Example: in 2022, rising interest rates caused long-duration bonds to lose over 25% in value, while short-duration bonds fell much less. 6. Pulling it together. Good investment research combines both quantitative, numbers, ratios, performance data, and qualitative, business model, leadership quality, competitive position, factors. You don't have to find the perfect investment, you need to find the one that best fits your portfolio's design and your personal plan. 7. The power of qualitative factors. Numbers tell you what has happened, but qualitative factors help you judge what might happen next. Some of the best investors, like Warren Buffett, have built their success on evaluating the quality of a business, not just its balance sheet. Key qualitative factors include management quality, track record, transparency, capital allocation decisions. Competitive advantage, economic moat, brand strength, patents, network effects, cost advantages. Business model resilience, how stable and adaptable the company is to changing markets. Industry position, market share, barriers to entry, competitive landscape. Example: Apple's brand loyalty and integrated ecosystem give it pricing power and customer stickiness, factors not fully captured in a P/E ratio. 8. The role of macroeconomic conditions. Even a great company or fund can underperform if macro conditions are unfavorable. Consider interest rates. Rising rates can hurt growth stocks but benefit certain bank stocks. Inflation. Commodities and real assets often outperform when inflation is high. Economic cycles. Consumer discretionary stocks do well in expansions, utilities shine in recessions. Currency movements. A strong dollar can hurt U.S. companies with large overseas sales. Action tip. You don't need to predict the macro environment perfectly, but you should understand how your investments are likely to respond to it. 9. Red flags to avoid. Avoiding bad investments is just as important as finding good ones. Watch out for high fees with no proven value. Poor liquidity. Hard to buy, sell without big price changes. Overly complex products you don't understand. Businesses with declining revenue and no turnaround plan. Funds that consistently lag their benchmark after fees. Data point. Morningstar research shows high expense ratios are the single strongest predictor of poor fund performance over time. 10. Building your shortlist. When you've done your research, narrow your options down to a shortlist that fits your target allocation, meets your return and risk profile, passes your qualitative and quantitative checks. Avoid rushing this process. A smaller number of well-researched positions usually beats a long list of maybe picks. 11. Creating an investment decision checklist. Having a checklist keeps you consistent and disciplined. A sample investment decision checklist might include: does this fit my target allocation? Have I analyzed risk, return potential, volatility, liquidity, and cost? Do I understand the business, fund strategy? Is management trustworthy and competent? Are macro conditions supportive or at least neutral? Have I identified potential red flags? Do I have an exit plan before entering? Pro tip: keep this checklist in a document or notes app so you can apply it before every purchase. 12. The final step: aligning with your plan. Every investment you select should serve a purpose in your portfolio. If it doesn't clearly add value, it's a distraction. The best investors don't chase the hottest idea, they execute their strategy with discipline and patience. Closing takeaway. Selecting investments isn't about finding a magic bullet. It's about matching the right assets to your personal strategy, using a repeatable process that removes emotion and guesswork. In the next episode, we'll move on to risk management, the overlooked skill that ensures your portfolio survives long enough to hit your goals.